Hi everyone, this is Kevin Kincaid and I'm your host for today's webinar entitled The New Economic Agenda, What Does It Mean for Stocks and Bonds? Presented by our guest speaker, AAFMAA Chief Risk Officer, Gary Aiken. We have about 30 minutes of slides for you today, and then we'll have plenty of time for your questions. Since your lines are muted, please ask your questions by typing them into the questions box on your screen. This monthly webinar series is brought to you by AAFMAA Wealth Management and Trust. We are AAFMAA's trust company. AAFMAA stands for American Armed Forces Mutual Aid Association and is the longest standing not-for-profit association that empowers military families with affordable financial solutions. We accomplish this by being the premier provider of financial planning, investment management, and trust services for the military not-for-profit. Also, as a trust company, we have an additional legal obligation to act as your fiduciary, which means we only act in your best interest and for your benefit. Here is an important disclaimer. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. Also, for regulatory compliance, we want to note that our guest speaker today, Gary Aiken, is an employee of our parent company, AAFMAA, and is not an employee of AAFMAA Wealth Management and Trust. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. Our guest speaker today is Gary Aiken, Chief Analyst and Risk Management Officer for the American Armed Forces Mutual Aid Association, or what we call AAFMAA. Mr. Aiken is responsible for oversight and analysis of investment operations, including asset allocation, manager selection, security selection, and compliance. He chairs AAFMAA's Asset and Liability Team and serves as Vice Chairman of the AAFMAA 401k Committee. He also advises senior management on corporate strategy. He has 15 years of investment experience and holds an undergraduate degree in economics from the University of Maryland and an MBA from the George Washington University. I will now go ahead and turn it over to Gary, who will review the agenda.
Thank you, Kevin. Good afternoon to everyone on the call. Besides this morning, this is my first time having the pleasure of giving some insight as to our thoughts on the markets and the future of markets. The same analysis presented today is being used at AAFMAA to invest the dollars that back our insurance obligations. We are not making this presentation to be deliberately favoring one political party over another or with any special insight as to what policies the new administration will promote. However, we have reason to believe that the broad campaign promises of the Trump candidacy will be met enthusiastically for the most part by the overwhelming Republican majorities in Congress. Today's agenda will go over that new presidency and the new economic agenda, the implications of that agenda on growth, inflation, and rates, and we'll also talk a little bit about historical parallels, and then we'll have some conclusions to draw. So, to start off, why are market pundits so darn pessimistic? Because rates have only one direction to go, down. Psychologically, we are still overhung from the past 17 years, and it's really quite a depressing story. The dot-com bubble burst and the stock market fell 50%. Then we were hit on 9/11 and entered ongoing war for the past 15 years. Then as things started to feel better, we became aware that the entire economy was a giant Ponzi scheme and the stock market fell 50% again. We were shown just how gullible we could be as investors through Bernie Madoff. We were all battered, broken, and distrustful. Well, except for us here at AAFMAA. PIMCO's pronouncement of the new normal in 2008 was met with skepticism at the time, but lower for longer, the idea that interest rates can stay at historically low levels just about forever became, over time, more and more widely accepted. The 10-year Treasury is shown on the chart you're seeing. It declined from 4% as we exited the Great Recession and fell to an all-time low of 1.34% in July, before bouncing back to 1.8% before the election. Growth has stagnated for much of this decade. Wages have declined on a real basis. Millions of people have left the workforce or are forced to take 2 or 3 part-time jobs just to make ends meet. So rates have only one direction to go, downward, to keep the economy from falling into 1937. Isn't that depressing? On top of that, stock valuations are pretty high. This is Robert Shiller's chart. Robert Shiller is a famed economist and investor from Yale University. He came up with something called the CAPE, the cyclically adjusted price-to-earnings ratio. You know what price-to-earnings ratio is. You take last year's earnings and multiply it by a factor called the price-to-earnings ratio, and that gives you the value of a company. Shiller says, okay, there's lots of things wrong with accounting, and there are always economic cycles. So let's value stocks against the last 10 years of earnings, or what would absolutely be a full cycle of earnings, and call that the CAPE. Shiller's CAPE shows that the market's valuation is historically high. Shiller's noted our CAPE today of 28.26 times earnings against 2000, 1929, and 1966. From 1966 to 1982, stocks barely kept up with inflation. And of course, we're sitting slightly above where we were in 2008 before the Great Recession. I'll come back to this later, but stocks are high on an absolute basis. And don't even think about watching television or reading the real or fake news. We start climbing the wall of worry. These are just some of the things you'll hear people talking about on TV all the time. They're ticking time bombs, booby traps waiting to be sprung on unsuspecting investors. Rick Convey, our Chief Investment Officer and President of AAFMAA Wealth Management and Trust, has a great chart in his investment outlook presentation, and I encourage all of you to go look at it. It shows all the events that should have caused us to be fearful over the past century. Fears will always be with us. Maybe it's time to trot out FDR. The only thing we have to fear is the Trump economic agenda. All right, so what did Trump promise from an economic standpoint? One of the things that he promised was more infrastructure spending. And of course, the picture that you're looking at is Eisenhower, who did the interstate highway system, and a quote from real Donald Trump on the campaign trail. The only one to fix the infrastructure of our country is me. Roads, airports, bridges, I know how to build. Politicians only know how to talk. Recent reports show that this infrastructure build will be part government spend and part private investment. For those of you who understand the Keynesian equation, aggregate demand in the economy is the sum of consumption, government spending, investment, and net exports. If this is real infrastructure spend, not just shovel-ready jobs, it could have an impact on 2 of our components. While it's a long way from proposals to actual policy implementation, let's take a look at what's been proposed and the possible impact on our investment portfolio. The second leg of the Trump economic agenda is tax reform. And of course, I've shown on this chart 2 pictures. At the bottom, Kennedy, who had major tax cuts in 1962, and Ronald Reagan, who unleashed multiple tax cuts. And some of the things that Trump is talking about on the personal side are reducing the number of brackets and eliminating some deductions. And of course, on the corporate tax return side, we're talking about reforming to a territorial system and also encouraging business investment. Now, tax reform has been talked about, especially corporate tax return reform, for years. But with one party in control of the White House, and even more importantly, both the Senate and the House, it looks like we have a real chance to see it. In the next few slides, we'll also go over the impact of these potential changes. And though I've trotted out Kennedy and Reagan, we'll see that the past doesn't exactly mirror the present, but it does rhyme. The third leg of the Trump economic agenda is regulatory reform. Now, most everyone on this call has been an employee of the federal government, whether you're military, civilian, contractor, or all three. So you've seen bureaucracy at its finest. While regulations and red tape are important to slow down and evaluate things of consequence and for the safety of citizens, it can also be an undue burden. Rex Tillerson has talked about streamlining the State Department, and Carl Icahn, who's pictured above, has talked about and acted against poor management in companies for years. Speeding drugs to market, allowing faster development for infrastructure projects will be beneficial. A faster speed will lead to more churn in the system, and more churn in the system will lead to more growth and inflation. The opposite of what we talked about a few minutes ago with the pessimism of the century thus far. Lastly, in the economic agenda is defense spending. And the quote here on this page is from 7 December, so after he was now President-elect Donald Trump. And there are also comments that were echoed most recently this week at MacDill Air Force Base in Florida. So I don't need to say much about defense spending. Trump has promised, and General Mattis has also pledged to look harder and more carefully at how dollars are spent in the Pentagon. But undoubtedly, the Pentagon is going to have more money to spend. Unless Trump can get the Saudis to pay for it, taxpayers will, or it will be borrowed money. Either way, more government spending. So what are the implications for future growth? There's a wide dispersion of how economies think these policies will impact us. On average, economies still think that the GDP will be lower for longer, in the 2 to 2.5% range that AAFMAA Wealth Management and Trust has as its base case also. The economists we've talked to also say that they can't really make a judgment yet about the impact on GDP of Trump's policies because they haven't seen the details. We also think that there's going to be more inflation in the future, and here's future inflation from economists. Now, I've got a longer running chart that's not in this deck, but basically it shows inflation expectations against actual experience. And the gist of it is that the longer time period, the more the market underestimates future inflation. This is interest rates. So in the next 6 months, economists are split as to whether interest rates go up or down. That's the two-handed economist joke in there, I suppose. But longer term, the trend is undoubtedly now for higher rates. At AAFMAA, we have been long secular bears on rates. We think that trend is over. When everyone's finally capitulated to the position of having lower for longer as their investment thesis, that's usually when the party is over. We think rates are going higher. So, interest rates are going to rise. What happens when interest rates start to rise? Well, corporate bond returns can go negative. A quick reminder, bonds are two parts, price and income. The income is set. You get what you get. But the price will change with changes in interest rates. For you to have a negative total return in bonds, the change in value due to interest rates rising needs to be larger than the income you earned by holding the bond. So, this chart shows long periods of negative corporate bond returns. Many of them are also short periods, 1 or 2 years. Some are steep, some are not so steep. There are 3 that really come out. One that everybody on this call will probably remember better, 1977 to 1981. And 2 you may be vaguely familiar with, 63 to 69 and 54 to 59. Corporate bonds are 2 parts as well. They're the treasury yield, which is the risk-free rate, and another piece called the credit spread that indicates how much more investors need to be paid to take the default risk of that company going out of business. In 2015, the line all the way to the left that spikes up, we had an energy crisis and corporate credit spreads widened. That means people demanded more interest to cover the likelihood of default on a bond. In 73 to 74, we had a huge recession. 77 to 81 was a tough time with huge inflation and a recession. The period 63 to 69 is a little different. And good, frankly. We didn't have any real change in the spread in corporate bonds. Corporate bonds had a negative return, though, not because the economy was bad, but because government bond yields went up. Bonds had a bad run because the economy was good. So what happens when bond goes bad? Well, we're always worried about the downside risk here at AAFMAA. And in bonds, the folks on TV are always talking about the change in price, but not factoring in the income you receive. And as interest rates go up, prices go down. But when we reinvest, we get to take advantage of those higher rates and we get more income. So, despite rates going up and down many times over the course of 1926 to 2015, there are actually very few periods that experience negative total returns in bonds. And, importantly, those numbers just don't seem that bad. If I told you you might lose between 1 and 4% on your money, you'd probably say, that's acceptable to me. And bonds aren't your only holding, though. So what happens when bonds get bad? Stocks get better? Yes, when bonds go bad, stocks get better. So the first three columns here are just the table form of the previous slide. The fourth column is what happened to stocks on average. Unless you were only in bonds and cash, you made money. A 50-50 allocation, a 60-40 allocation, or a 70-30 allocation. Whatever level of diversification you took on your risk tolerance level worked out just fine. So maybe FDR was right. The only thing we had to fear was the dreaded black swan. If you don't know the term, it's from an economic philosopher named Nassim Taleb, who published a book in the aftermath of the financial crisis with the same title. Black swans are events that are completely unpredictable, but we all try to rationalize after the fact why we should have known about them before they happened. This chart shows all of the periods between 1926 and 2015 where stocks and bonds were negative at the same time. 5 years. While we don't expect the Fed to continue to tighten, which was present in 31, 69, and 81, we don't have any reason to believe these types of events are likely to occur in the near future. But by their nature, black swans are elusive. If they did happen, history shows they are major buying opportunities. One more thing about stock valuation, which we said we'd return to. At AAFMAA, we like to think in terms of relative value, not absolutes. We have options. So we weigh those options against each other and debate their relative merits and build portfolios over time based upon the choices the market presents. Remember Shiller's cape at 28 times high was historically high. And that's an absolute measure of valuation. On a relative basis, things look potentially less ominous. Inflation is running roughly 2.2%. The box on the left says that bond yields should be much higher than where they are today. And that jives with our presentation so far. We think rates are more likely to rise. The two boxes on the right side show that when inflation is in this range, the regular PE on the stock market should be about 18 times earnings. And today the market PE is somewhere around 20 times. And when inflation is in this range of about 2.2%, the market average is around 12% total rate of return. So it's not readily apparent that we should be concerned about the levels in the stock market, historically speaking. Now let's try to draw some historical parallels. So remember the line, I knew Jack Kennedy, and you're no Jack Kennedy. Well, Trump may be a great communicator, but he doesn't inherit what Reagan inherited. The economy today is much stronger than Reagan's recession economy in 1981. Real GDP is growing versus contracting for Reagan. The CPI is low, that is, inflation is low relative to the 12% inflation of Reagan's 1980. The unemployment rate was elevated against a near full employment in 2016, and the Fed funds rate at 22% and the U.S. 10-year Treasury at 12.4% are much higher than where rates are today. So if it's not like Reagan, what periods could it be like? Well, maybe like Ike. One of the periods that we studied was 1955 to 59. Maybe Trump can be like Ike. Inflation went up, GDP averaged a decent number, and long-term bond yields rose from low levels. Bonds suffered, and stocks did well. During that period, long corporate bonds were down about 0.3% per year, but large cap stocks were up 15% year over year. What about 1963 to 1969? Kennedy imposed his tax cuts, and also the Vietnam War was another weak period for bond returns as rates rose from 3.9% to 6%. Inflation moved from 1.6% to 6.2%, and GDP grew for the whole period at a nice clip. Again, bonds suffered, but stocks did okay. At 9% per year, large cap stocks did about 1 percentage point below their long-term average rate of return. We think this period could be a reasonable historical parallel for the Trump economy. So in conclusion, we think government policies may spur higher growth and higher inflation. Those inflation pressures will lead to higher interest rates, and longer duration bond portfolios may experience negative total returns. But past episodes, especially 63 to 69 and 55 to 59, have shown that in these environments, the stock market continues to perform well.
Great, thanks, Gary. That was fantastic. And all of you might be wondering, okay, so what do I do now? And what we'd like to do, I asked Art Lyons from AAFMAA Wealth Management Trust to join us today and just share a little bit about what the trust company can offer you as you look at your own situation.
Thank you, Kevin. Thank you to Gary for that tremendous insight. I always enjoy listening to your thoughts about the markets. One of the things that we always invite our members and other listeners to do is to take advantage of some of the complementary services that we offer with wealth management and trust. And the primary one that I think many people have already turned to us for, that is a complimentary portfolio review. It's an objective look, a second set of eyes, if you will, on an individual's portfolio, where the primary emphasis is to analyze the risk that has been taken, the risk that may continue to be inherent in that portfolio, and balance that versus the return performance of it to get, I guess, a better handle on whether or not a client has been compensated well enough or high enough for the level of risk that they've taken. So very simply, all you have to do is to provide a recent investment statement, and you can email that to us at wealthmanagement@afma.com. There's two other services as well. One is called a financial dashboard. It's an online service that we provide free of charge that better enables our members and clients to organize all of their assets in one easy-to-follow online spot. And then finally, we have been providing monthly webinars now for over 3 years on a variety of topics. It's easy to locate those webinars. That's at the wealth.afma.com site. And you can learn more. We believe financial education is an important component of what we do. And so you can learn more about a variety of topics by going to our webinar series at that website address. So we want to encourage everyone to take advantage of the number of free services that we're offering our members. Thank you, Kevin.
Great. Thanks, Art. That's very helpful. And we've collected a few questions already. I'll leave our contact information up here while we go through the questions. So first off, Gary, thanks for your insights today. In your analysis, you say 1926 to 2015. What's special about that time period?
Thanks, Kevin. We didn't start this analysis focused on exactly the new administration. We started with a base view that the secular trend of the past almost 40 years of lower interest rates, lower inflation, and less impactful government spending were more likely to be over and starting to reverse. In that scenario, interest rates would move higher. As a mutual association managing general account assets of an insurance company, AAFMAA invests the majority of its money in bonds and bond-like investments. The average investor has heard now for long enough that if interest rates go up, then bond prices go down. We wanted to test what the total return outlook might look like and how we should expect that portion of our portfolio to perform. Why 1926 to 2015? Well, because we had excellent data from a number of very qualified sources. The data going further back is less reliable.
So you started with bonds. What prompted you to look at stocks then?
Well, AAFMAA invests on average between 10 and 15% of its own money in stocks. Not because we wouldn't want to invest more, but regulators and actuaries have determined that that's a prudent range for life insurers. One of the theories that we thought was true was this. The price-to-earnings ratio can be thought of somewhat as the inverse of a bond yield. Some investors might understand this more formally as part of the dividend discount model. In real estate valuation, this is called a cap rate. In any event, we thought that PE ratios might fall and that all else equal, stock valuations might be hurt or that the stock market would underperform its long-term average during long periods of interest rates rising. The data showed just the opposite.
So how did you get to the economic agenda?
Well, we found a couple of examples that historically paralleled the types of things that the Trump campaign referenced as part of their agenda if elected. While no real policy has been promulgated yet, we made the broad assumption that they'd at least move in the direction they campaigned on, and we'd get some mix of military and infrastructure spend, a relaxed regulatory environment that would encourage industrial growth, and lower tax rates, which would induce additional economic growth. The period in the 50s and the 60s happened to overlap.
So what are the risks to the outlook?
I show the wall of worry on one of the slides, and there's always something to be worried about. However, you asked about the risks to this outlook. In my research, I'd have to point out that probably 73 to 74 and 77 to 81 is examples of rising interest rate periods with disastrous results for bonds and stocks. So what kinds of things are risky? We'd have to watch out for European disintegration as Brexit unfolds, and Marine Le Pen seems to be gaining traction in France. Also, China remains a black box, and how they move towards floating their currency will shift the global currency regime. Not entirely the way Nixon coming off the gold standard did, but history doesn't repeat, it rhymes. I think an oil shock, higher oil prices, is not a very likely outcome given policy changes we expect and technology changes that have revolutionized the discovery and extraction of oil and natural gas. So the risks come mostly from abroad. But if we had a downturn in the markets like those two instances, they would be a fantastic buying opportunity for long-term investors.
That's interesting. So why for long-term investors?
Well, AAFMAA has been around for 137 years. We've survived multiple stock market crashes, panics, depressions, recessions, and world wars. We don't have any debt, we don't use derivatives, and we don't invest in things we can't understand. So we didn't have any subprime mortgages in the recent crisis. We think long term. We're writing policies for members who can expect to live another 50 years or more, and even those entering or in retirement can expect to live longer than ever before. We think most people should be focused on the long term and not be frightened by short-term market blips, panics, or crashes. We were excited to start AAFMAA Wealth Management and Trust in 2012 because as a trust company, it can take care of members and their families, children and grandchildren over the long term. It's what AAFMAA's been doing in life insurance, VA assistance, survivor assistance for over a century, and we're so excited that Rick Convey and his team at AAFMAA Wealth Management and Trust can further that solid experience for our members and their families.
Wow, so only since 2012. That's not bad for a 5-year-old company.
The most mature 5-year-old company I know. We couldn't be prouder of AAFMAA Wealth Management and Trust and what they're able to do for those who have served the country by growing and protecting their money.
That's great. So just a couple more questions here. With your base case, what is your recommendation for asset allocation versus your long-term investment policy? And what should I do with to manage my money?
Well, you should talk to your relationship manager at AAFMAA Wealth Management and Trust. And if you're not already a client, you should definitely call or email AAFMAA Wealth Management and Trust at the information provided on the screen. We can help anyone who's currently serving in the armed forces or anyone who's retired from or a veteran of the armed forces. If you haven't called us before, you can get a free portfolio review, and I highly recommend that.
Great. Thanks again for your time today, Gary.
It's been a pleasure, and to everyone on the webinar, thank you for your service to our country and for your trust in AAFMAA and AAFMAA Wealth Management and Trust.
Those were some great questions. If we didn't fully answer your questions or you think of another question later, please reach out to us at wealthmanagement@afma.com. We'll go ahead and break here for now, but you can reach us whenever you need to. Please don't hesitate to reach out and ask for help. Empowering members with the best possible financial information and advice is what we do, and it is our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. And you can always sign up for future webinars or review past webinars at wealth.afma.com. If you found this information useful, please share it with your friends and family. Our membership grows stronger every year because you introduce your friends to AAFMAA. Thank you again so much, and we hope you enjoy the rest of your day.